how to use life insurance to help pay for one of the biggest assets that you will ever own, your mortgage. That and other questions, family, we will dive into today's video, which, as you can see from the title of the video, is exactly what I just said. So let's dive in. You see, for most people, when they get a new home, they're all excited, they're all happy, they're all thinking everything is going to be great. And it is. You've got a good thing. You've got a roof over your head. You've got a place to have a whole bunch of family memories and a few different things that you can celebrate now with your family. And so a house is a beautiful thing. And your house is obviously one of the biggest purchases that most people will ever make in their entire life. Okay. So now with that purchase, comes a whole bunch of different things that people now have to worry about, different bills that they didn't have to worry about compared to them renting or staying in their parents' home or whatever they're doing. Now they're now having to worry about those things. Obviously, the first one is making the mortgage payments themselves. Now, for most folks, that's ranging anywhere from around 900 to almost 1,500. In some places, almost 15,000 or somewhere like that. You rich folk out there. So either way, for most people, their home is their safe haven. And so it's their job to fully protect that, because it's not just them inside the home, it's their family, it's their wives, it's their husbands, it's their partners, it's their children, it's their loved ones, whoever it may be, is living in that home with them. Unfortunately, when all the things are happening in your life, there's one thing that you're not thinking about happening to you. And so unfortunately, you no longer being in the current situation that you're in, where you're able to go to work or procure any type of employment or income that you're currently bringing in to yourself. What would life look like for you if you can no longer pay the mortgage? And not just being delinquent on the mortgage because you don't want to pay it, but because you unfortunately couldn't because of some injury, something that you didn't foresee happening, something that you didn't know that you were going to obviously get diagnosed with cancer. You didn't know that you were going to get diagnosed with leukemia. You didn't know that you were going to get diagnosed with Alzheimer's. God forbid you didn't know that you were going to get hit by a bus or pass away before you're planning to. Unfortunately, this is a reality for a lot of homeowners. It's estimated that over 3,000 homeowners every single day, unfortunately, lose their homes due to foreclosure. And out of those 3,000 of them that are losing their home to foreclosure, about half of them lose their homes because of some critical, chronic, or terminal illness that they did not see coming. And these are young people, people in their 50s and 60s. I know us younger folks would like to think that, people in their 40s and 50s are old, but these are still young people, still in the prime of their youth, still in the prime of their life. But unfortunately, if you're not planning, trust me, someone's planning on you. Now, how does all this make sense? How does life insurance help you pay for your mortgage or help you with any of your big assets that you might have if you couldn't make the payment? Um, well, before we delve deeper into that, let's first analyze what most of you, or most of us, maybe you're very intelligent, so probably you're not thinking this, probably you are, okay? But some of those other folks out there, what they're probably thinking. Life insurance, for most folks, is pretty much death insurance. When you die, your family, your beneficiary, whoever it might be, gets a lump sum of money paid out to them by the insurance company. Beautiful. Fantastic. Great. But how's that going to help you when you're still living and unfortunately you can't make the mortgage payments, but you have not passed away yet? Because unfortunately the bills are still going to come in. And because the bills are still coming in, the bank needs their money. And unfortunately, because you are the breadwinner for your family, you're a big, strong man. These weak little muscles, but I know you out there, you're a big, strong man, or you're a big, strong woman. And unfortunately, um, you're not able to be as vibrant as you once were. So, although the life insurance policy that you may have from work may be fairly decent, unfortunately, you're not dead yet. And for most people that have just regular work insurance policies, unfortunately, when they get sick or something happens to them or can no longer work, or God forbid, the worst, the good Lord decides to call them back before they were expecting it. Well, in some cases, that might not be the worst for some people. However, the planning that most people have doesn't go that far. And if all you had was just the run of the mill policies that only paid out when something happened to you, when you passed away, your family will still need money while you're still living and you can no longer work. So, where does this all lead to? You see, most folks are thinking about the old type of life insurance. When, there's a new kid on the block that's been around for, I guess, over a decade now. Um, it's called term insurance with living benefits. Now, keep it very simple. I don't want to get too weedy in this video, but keep it very simple. Living benefits are the same life insurance policies that you have, that comes with a death benefit, but also comes with a living benefit. Those include simple riders such as terminal illness, chronic illness, and critical illness. Now, what does that mean? A terminal illness is, as you know, unfortunately, when the doctor says you have 12 months or less to live, or in some cases, about 24 months or less. Okay. A critical illness is anything where the doctor says you have cancer, stroke, heart attack, or some complication with diabetes where you get a limb chopped off or something like that. Something that we don't want, that some things that we don't actually want to think about. And now, chronic illness is anything where you're unable to do two out of the daily activities of daily living. That includes eating, walking, and brushing your teeth, using the bathroom, exercising, doing simple things like that, simple routine tasks. If you're unable to do about two of those activities for any, depending on the insurance company, for I guess about 2 weeks to about 6 weeks, depending on the insurance company, the insurance company would advance you a certain amount of money while you're still living, and they will do that for all the main living benefits riders. How does all that even make sense? Okay, let's rewind it a little bit. Again, as we said in the beginning, most people lose their homes because of foreclosure. And half of the people that lose their homes due to foreclosure are losing their homes, not because they are up and decide that they don't want to pay their bills anymore. It's literally they can't pay their bills anymore because they can't work. And I know what you're thinking. Some people, they do have health insurance, they have long-term care, which is all beautiful things. You should have all those things for yourself if you can. Okay. And they also have different savings plans, retirement plans, and all that type of stuff. And I say, yes, that's fantastic. But wouldn't you want to use those retirement plans and health insurance plans, which we'll talk about in a little bit, and all those other savings that you have for yourself for what they're meant to be used for? Wouldn't you want to protect those things if you could? And not have to dip into your savings, which you're planning to possibly donate to your grandchildren or possibly go take a trip to some Caribbean island with your wife or renovate the home when you retire, whatever it is that you want to do. Most people aren't thinking of using that to make hospital payments. And God forbid, if you're no longer here with us, sometimes I know you're a smart man, smart woman. I'm talking about somebody else though. Those people sometimes they didn't necessarily put specific riders on their retirement savings plans and policies so that when something happens to them, it'll roll over to their spouse quickly. And so the average rollover rate is anywhere from about 3 months to, God forbid, sometimes almost 12 months. And we know that the bank and other creditors and other people that are going to come to collect bills, they're going to come after their money within about 3 months of you being delinquent. And so, unfortunately, if you're just relying on the old form of insurance as well as your retirement savings plans for most people, all of those are good things. It's not necessarily a fully concrete, I guess, solution for the problems that we know we're going to have. And unfortunately, as Americans, I don't know if you're looking around, we're not getting any healthier. Um, Diseases are on the rise. Few things are happening to people, and this is generally coming from my heart. things are happening to people at a rate that we weren't expecting to happen. You know, we love the food, we love the delicacies that we have that God has assured us to have in this country, but that does come with its drawbacks. And so we have to prepare ourselves for the life that we know is going to come. We know that eventually 70% of people are estimated to have a chronic or critical illness happen to them later down their line. And we know that, I don't know about you, but I know, but for most of us, we're going to eventually pass away. And when that does happen, we want to make sure that the people that are depending upon us to live their life, if we are the patriarchs and the matriarchs of our family, and these people are depending upon us to live a good life, we want to make sure that their life is good, because the old type, new type of life insurance, whatever it is, whatever you have for yourself, is really not for you, but it's for you for the same time. Life insurance or whatever it might be is for people who care about someone, whether it's your wife, your husband, your daughter, your son, your niece, your nephew, a charity, whoever it is. You have to have a heart to care for someone else. That's what this is for. Okay? Now, so let's get back to you. Let's imagine you're a good father, and typically, you'll say, imagine you're about a 45-year-old man. You have a son that lives with you, a daughter that lives with you. Your son is in high school, your daughter's in middle school. You work 9 to 5 job. You go to work at 8, come back at 4. Your wife does the same thing, but she doesn't make as much money as you. Okay, let's say your name is Bill. That's a decent name. Your name is Bill, and so Bill, you go out to work. You enjoy your work. Let's say you are a office consultant. People come to you when they need a solution. You're a big, strong man. People come to you when they need things. But who do you go to when you need something? Let's see. Okay, and we're back. Looking at Bill, 45-year-old man. Now, what we didn't go over is Bill has a wife named Nancy. Nancy is 43 years old. Okay, as we were discussing, Bill has a nice office job where he's a manager and he's bringing in, let's say, around 85,000 per year. Okay, Nancy isn't currently working anymore for right now, so Bill is currently handling all the bills. Okay, Bill and Nancy have 2 kids. Okay, but as them having 2 kids, these 2 kids, as well as Bill and Nancy, they have to have a roof over their head, right? So their mortgage, let's say at 123 Main Street, is around 450,000 per the term of their 30-year mortgage. Okay, so as we see their finances right now, let's say Bill has a good rate on his mortgage, right? And he got in at a good interest rate. Let's say the mortgage payment is currently, let's say, around 1,800 per month. Okay, should probably be a little bit more than that once you include interest and fees and all that other stuff as well. Now, mortgage plus they got to eat. So let's say to feed a family of 4, so that's around 500 per month on the low end. Food, okay, and let's say as well they also utilities. Let's say another 500, a decent sized home, utilities, plus let's say they have streaming services that they're paying for, Netflix, Hulu, Disney Plus, all that fancy stuff. Let's say they have now 150 on that streaming service, okay? Plus, and let's say 450 for this miscellaneous insurances that they may have, car insurance for both Bill and Nancy's car, plus other bills that they might have. Let's just include that all in one. Okay. So all my math nerds out there, I'm pretty sure you guys have already calculated this by now. Now, if we're looking at all of Bill's and Nancy's expenses comparatively to the amount of money he's bringing per year, so that's around 85,000. It's all pre-tax money, so divided by 12, that would be around $7,083 per month. Let's say, I don't know, after taxes, that goes down to about 5,500 after taxes if he's lucky, depending on what state he's in. Right, it comes down to about 5,500. So after all of his expenses, with his food and everything else, he's bringing home about 2,100 that he can invest or do whatever else he wants to actually do. Okay, but what we didn't say, or didn't let you guys in on, is that Bill, whether he knows it or not, Bill eventually in the next 2 or 3 years, he doesn't know this, but it's happening. It's going to happen. Bill is eventually going to fall into some critical illness, and because he's the only one currently working, all these bills eventually are going to fall on Nancy. And unfortunately, Nancy isn't going to be able to make the mortgage payments if Bill is no longer working. Now, Bill is still alive, unfortunately, but he's not well. Now, let's say, for all my naysayers out there, let's say Nancy eventually starts working. She gets a, I don't know, $50,000 job or something like that, which she's bringing $50,000 per year. That amount of money, let's say, is about 3,500 after tax money. That's barely covering all the mortgage and utilities that they're going to have. And so, because of that, that's going to put a strain on the pockets of all of them. Now, Bill, he has other forms of insurance that he has through work, but unfortunately, these insurances are going to cover him if he's no longer working, or if he just has some run-of-the-mill personal life insurance policies that he already had himself. So, where does all this make sense? This is Bill right here. I told y'all don't make fun of my drawing. It's Bill right here. Strong man, I told you. Nice long hair. That looks like Nancy from the way I'm drawing it. This is Bill right here. Macho man. Okay. This is his wife Nancy. I know Nancy got the big head. Okay. She got the really long hair. Okay. This is Nancy right here. Pretty lady. Okay. She got eyes. Big smile on her head. And this is their two kids. Okay. This is the boy right here. He got a nice cap. All right. And this is his daughter. She's a nice long hair like her mother. Okay. All of them, Nancy and the two kids, are relying on Bill's salary to make all the mortgage payments for the family. So all this runs because Bill is making it run because he loves his family. Okay? And so if Bill wasn't here, all this 3,400 would fall on Nancy and the kids and their mortgage. Don't worry about the streaming services and car insurance and other bills and other utilities. The mortgage, the biggest one they have, 1,800, and then the food, because the family got to eat. All this would have to fall upon Nancy, and if Nancy can't cover it, the other family members, the other families can't cover it. Unfortunately, the bank is going to come take the home. Unless, let's say, if Bill was a smart, intelligent man, which I know he is, Bill has $2,100 to invest. Okay, what Bill could do, because he knows that it's not if but when something does happen to Bill, whether he's living or he passes away, he's going to insure his family. For most people, 45-year-old man, to cover, let's say, a $450,000 mortgage for 30 years, he'll get a life insurance policy with living benefits. That's the difference, with living benefits that covers chronic, critical, and terminal injuries. Okay, with living benefits for about this amount of money, anywhere from around, just being honest, 150, depending on the company, to as little as maybe $50, depending on the company and depending on type of comorbidities that Bill may actually already have in his life. So from anywhere from around $150 to around $50, Bill can get a policy that can cover $450 $1,000 of coverage that if he's still living or if anything happens to him, he can cover his family so they don't have to worry about anything when he passes away. So Bill is securing. So let's minus this on the high end, and let's go even higher. Let's say $200 for the policy that Bill has. $200, okay, for a good life insurance policy that covers $450,000 for 30 years. Okay, we minus that from the 2,100 that he has to play with. Pull out the calculation right in front of you guys. So 2,100 minus 200 for insurance policy, that still leaves Bill $1,900 for him to mess around with and do whatever he wants to do. So for $200, Bill has the opportunity to get into a good insurance policy with living benefits that will be there to protect him, his wife, his son, and his daughter. I didn't give the daughter any eyes. Oh man, she's got a big smile on her face too because she's daddy's little girl. Okay, his children and his wife are Bill's pride. And he's making sure that he's taking care of them. All right. And so what this policy is doing is that if Bill is either passed away or he's going through a chronic, critical, or terminal injury, there's a lump sum of money to show his love for his wife, show his love for his son, show his love for his daughter, so that if he's no longer here or incapacitated in any way, this mortgage does not become a burden upon any of his loved ones, whether he's here or he's not. Okay. Now, for most people, it might not be $200. For some, it might be as low as 50. Who knows what it is? To actually get that quote and actually get what's out there for you, talk to a licensed agent, a licensed broker, and if you want to partner with me or to get more information from me, feel free, depending on whichever platform that you're seeing this on, to reach back out to us and to get some more information on this. Okay, so if you guys could understood a little bit of what I drew right there in my scribble scratch. So what this is doing for Bill and his family, and also for yours possibly, is it's protecting what needs to be protected, which is his loved ones. Okay, Bill isn't getting this insurance for himself, although it is for himself if something were to happen towards him. However, when the good Lord does decide to call him back, there's a lump sum of cash that's going to be set apart for his beneficiaries to take care of them, as well as any of the other bills, so their life isn't as hard as it could be if something like this wasn't in place. Okay, now something that we didn't talk about fully in this video that we'll get to in other videos is how this simple investment or deposit that he's making in his future is protecting his savings, his retirement, his investments, as well as his mortgage and credit and other assets, to make sure that when something does happen to him, all those other assets that he has are being put in the proper place and being taken care of properly, so that they remain an asset and not a burden. Okay, so this is how, for most people, for most average people from around age 30 to about 55, can take care of their mortgage and make sure that life insurance with living benefits is helping them secure them and their family's future. Okay. Now, for certain people who are a little bit older, who are a little bit younger, this strategy can still work, but there needs to be a few tweaks here and there to, I guess, really cement the benefits for them. So if you are a little bit older, a little bit younger, or Bill's and Nancy's age, please feel free to reach out to us, message us, DM us, comment. I post videos on different platforms, so whichever way that you have the ability to reach out to me, please do. So I just want to say, hopefully this information nourished you, and you can share this video with someone who you find will find benefit in taking care of their loved ones. Thank you. Take care.